Welcome to the show. I'm Andy Hagans, and today we're talking about the future of alternative investments. Joining me today is one of the leaders in our entire industry, in our space, iCapital's Steve Houston. Steve, welcome back to the show.
Great to be with you, Andy.
In our first episode that we recorded, time flies. That was episode number 64, and we're at like episode 164 now. So time flies when you're having fun, I guess. And I'll link to that episode in our show notes. I remember for me, it was a big deal. I was like, wow, I have iCapital on this podcast. I guess I'm official now. It was like a big milestone for me. I'm sure that most of our listenership is familiar with iCapital, but for any who aren't, do you mind giving us a brief introduction to the company?
Absolutely. And like I said, it's wonderful to be back with you. And I'm glad we were an early engaged partner on your show. iCapital is a B2B business. We offer technology that allows financial advisors to more easily tap into the alternative investment universe of managers, and technology that allows those alternative managers to more easily tap into the wealth management sector. And so those are our two client bases: wealth managers on the left and private asset managers on the right. And we manage about $175 billion through our platform. And we have a little over 100,000 financial advisors who come directly to our website, if you will, to access those alternative managers. And we work with about 250 alternative asset managers. So that's kind of our ecosystem. And it's part of this really a super trend of private wealth managers allocating more and more to private markets from the public markets. They've traditionally built portfolios for clients using public market content, stocks and bonds and funds and the like. And there's a big shift that we sort of sit in the center of, where they are more and more allocating to private markets, private real estate, private credit, and private equity.
Yeah, talk about a mega trend, and iCapital obviously very well positioned. I think in our last conversation, it really stuck with me. I think it was a great phrase that you used, that iCapital has created a lot of the connective tissue in the alternative investment space, kind of behind the scenes, I guess, for a lot of high net worth investors.
Yeah.
Maybe aren't familiar with iCapital, but I think you all are positioned to, based on your clients on the right hand and on the left hand, you kind of have your fingers on the pulse of the industry. I want to dive into our main topic today, but before we even do that, you know, as you have your fingers on the pulse of the industry, how is the industry this year? This has been kind of I don't want to say an odd year, but it's a unique investment environment, and real estate's obviously slowed down. Real estate's kind of the biggest
Yeah.
sector. Alts, has it been a good year at iCapital in the industry overall?
Yeah, it's a growth year, but the growth rate came off. There's no two ways about it. Our assets that we manage through the platform have grown quite a bit this year, but the trajectory, has come off. And I think really what happened was, this year is sort of a hangover from last year. Last year, clients, lost a lot of money in the public markets. And it was one of those odd years where you lose money in stocks and in bonds.
Mm-hmm.
And it definitely impacted how people invested in 2023 and this year. And a lot of things slowed down. That mega trend that you just referenced, Andy, is still there. It's like the first inning probably. But it was sort of a hangover a little bit from last year. And then, as you also stated, a certain segment of the private asset world slowed down quite a bit, that being private real estate. And, the interest rate environment and some of the headlines with funds needing to prorate those who are redeeming, it had a little bit of an effect across the entire industry.
Now, does the higher interest rates affect private equity as well, or was that a more muted effect that higher interest rates had?
Well, it didn't. It does sort of indirectly, it's affected valuations. And, if anything, there's like more interesting entry points today, for those private equity managers that are now deploying capital. The valuation paradigm has changed quite a bit. And so that sort of excites us, frankly. Even for real estate, like if you're an opportunistic real estate investor and you've raised capital more recently and you didn't deploy it more recently, it's a really unique opportunity. I mean, there's going to be so many. I actually think this is going to be one of the best vintage years for investors across private equity and even real estate, opportunistic real estate. If you're willing to put money to work, a lot of people get scared by the headlines, and totally understandable. But it's, again, one of those things where I bet if you looked back in 5 years, it would be one of the better vintage years to have been deploying capital.
Yeah, and certainly in secondary markets, you can see, I mean, I would say valuations are more realistic. Maybe you could say they're more attractive. And it's interesting, where iCapital sits, you could almost view that valuation reset as a good thing, right? Like you all are growing through this period anyway, like, the headwinds notwithstanding, but probably the fact that there's a little bit of a valuation, not a little bit, there is a valuation reset going on. It's probably better PR for the industry overall, right? That it's just a healthier place to invest right now.
I think so. And the flip side of that is there's a competitive product out there now called cash, and it's just amazing how a lot of different investment strategies, certainly not private assets, but I mean venture capital and even the public markets, they were driven by a zero interest rate environment, and you had to be, frankly, pretty creative on putting your money to work when cash was earning nothing. And now that's changed, and you can earn 5-6% in low risk instruments. And kind of coming back to what you said earlier about the state of the business this year, that hangover from public market decline last year has hurt the industry broadly a little bit this year. But cash as a competitive instrument, people are happy kind of waiting things out. But again, it's one of those things where you look back and you think, gosh, I wished I had invested that year.
Yeah, be greedy when others are fearful, right?
Yeah, totally. I mean, if you can be a liquidity provider in a time like this, especially in distressed assets, be it real estate or distressed credit, you're just going to earn really handsome returns. It's that classic equity return profile for being more senior in the capital stack.
Yeah, if only we could all have that, weird psychological bug that Warren Buffett has in his brain, that allows him to be fearless when times are bad and patient when times are too good, valuations are too rich. It's, human beings where we tend to be our own worst enemies. But absolutely, I agree with you that this does have the potential to be a great vintage.
Yeah.
For capital being deployed this year. Well, I want to shift to our main topic today, which is really the findings in the recent iCapital. This was proprietary research, and I'm going to pull up my notes and read from this because I want to make sure I get every detail correct. So it was a survey of 400 registered financial advisors in the United States. And frankly, I love this research. I'm already kind of borrowing from it. I always give you guys credit, but it was just, it was full of like really important data points, I thought, in 2023. The first major takeaway I had that I want to ask you about, it was in the methodology section at the very end, and I quote, 80% of the survey sample of advisors currently use alternative investments in client portfolios. And additionally, almost all of the advisors surveyed say they plan to allocate the same or more to alternative investments in the coming year. So I'm thinking, on the one hand, I agree with you. We're kind of in the first inning of this tailwind. But on the other hand, if the future is alternatives, I feel like, well, is the future finally here? We have 80% of advisors using alts in their client portfolios.
Yeah, and I think that, first of all, just to give the listeners a little bit more context, this was actually an anonymous survey. We didn't come out with iCapital branded all over this. We didn't want to almost like cherry pick or have people self-select. We used an independent agency to go out, and it was a really, pretty good sample set and really good data that came back. There's lots of questions that were asked through that, but I think because it was anonymous, we felt even better, about the engagement in the survey. The advisors, advisors are using alts. The big thing though, Andy, is and this came out in the survey as well, they're not using it in a comprehensive way across their book. They're using it with their larger clients, number one. And number two, they're mostly using things like real estate, and they're mostly using things like non-traded REITs. And that's great. And it's been a fantastic product. It will continue to be a fantastic, product. But it's been, you have to kind of peel that question back even more. Like how much of their client base is actually using alts? What's the diversity of the alternative usage within that client cohort? So on the headline, you're absolutely right. That's very encouraging. It doesn't suggest that we're in the first inning. It feels more mature. But when you look at penetration and diversification of products, I mean, we're in the first inning for sure.
Yeah, that's interesting. It almost pertains to this show. When my business partner, Jimmy, he wanted me to launch the Alternative Investment Podcast. He came up with the name, and I didn't really know what I was getting myself into, because, I've had people ask me, "Oh, you're a podcaster. Oh, well, what's an alternative investment?" And I'm like, "Well, it's anything besides stocks, bonds, and cash."
Yeah.
And then they'll be like, "You mean X? You mean Y? You mean Z?" And I'll be like, "Yes, yes, yeah." There's just so much, and I think at some point it's almost unrealistic to expect any one advisor to really be comfortable with however many sub asset classes there are in this space.
Well, I also think that we're on a little bit of a mission to change the lexicon or the vernacular that the industry uses, which is maybe it's not alternative investments. I mean, just those words is like an alternative to what? It's really public markets versus private markets. And the public markets swim lane is where financial advisors and where virtually every client has deployed their assets. And the public market swim lane is where we, offer a service, and it's hard to access private markets. Just by virtue of being private, the offering process is different. The documentation is different. The education is different. The asset classes and the ways one can generate returns are different than what you have in the public markets. And so, really what we're talking about here is private markets. And, how do you access that, and what are the return streams that investors might expect from that? And really importantly, what do they get out of it when they introduce it into their portfolio? Like, what does a portfolio construction look like? And what are the benefits of adding private market content to an otherwise public market portfolio?
Absolutely. And I know IPA, the industry trade group, they use, I think it's PDI, portfolio diversifying instruments. And that kind of gets to the heart of your point. That label for alternative investments kind of leans into one of their main benefits, right? The fact that they diversify the portfolio, although it doesn't really go off the tongue so easily, right? I kind of like private investment. That sounds a little bit sexier. So, I take your point, though, is that, the verbiage in this entire space, it actually drives me nuts, just trying to define private equity, and you get 50 different answers from 50 different people that might.
I'll give you, I was on another trade group conference call yesterday, and the topic was interval funds. And what an interval fund, at least in the current version, holds essentially are investment strategies that invest in private lending and in private debt. And the industry has decided not to call that private lending, which you might understand, or private debt, which you might understand. Instead, they decided to call it interval funds. And interval funds is just a chassis. It's this kind of regulatory structure. And I don't know why the industry does that. It's like, call it what it is. It's not public bonds or public fixed income. It's private fixed incomes. Call it that.
Totally. And I think that is part of it's kind of like complexity squared, right? Because you have alternative asset classes, and then you have these wrappers, right? You have Delaware statutory trusts, you have interval funds and other intermittent liquidity products. And I think a lot of people do get tripped up on the wrapper. But there's a lot of awesome wrappers, right? Like I kind of understand why, because
True. I mean, look, MLPs, everybody knows what an MLP is, and they've been around forever. That's also kind of a regulatory chassis.
Right.
that holds, different things, generally energy assets. But so I don't know. It's interesting, how the nomenclature can sometimes be a barrier. Like if you're pitched an interval fund, I've heard advisors say, well, what is that? But if you say, oh, you know what, forget about the name. It's actually just private lending. You buy public bonds or you buy private. Oh, I get that.
Yeah, you're right. And until we have common language, that probably is a little bit of a limiting factor in the space. But you know what? I think that's above our pay grade for
Yeah.
today. I want to move into some of these strategies and asset classes. This is my favorite kind of poll question. I love hearing about what people are putting in their portfolios, what asset classes are, quote unquote popular right now. So I'm going to quote from the report. So among advisors currently using alternatives, 78% invest in real estate. So no surprise there. That's the largest,
Yeah.
private asset class. And then 62% invest in private equity, 50% in private credit. That was a little higher than I expected. And 48% in hedge funds. More than one third of advisors said they're most likely to increase allocations to private equity and private credit in the
Yeah.
coming year. So, Steve, in your experience, are those two really the hot asset classes right
Yeah.
now?
Yeah. Well, especially private credit right now, because it truly is a new asset category that financial advisors didn't have. Private company lending was a space that banks were doing, and the big non-bank financials and private credit funds on behalf of institutional clients. And there was no access point to the private client community for that type of return stream until things like BDCs and interval funds, started to be launched. And they continue to be very popular. They continue to do generally exactly what they were designed to do. A lot of the content in there, again, is loans, and they're floating rate loans. And so they're kind of getting a little benefit, from short-term rates. They're floating plus a spread. And so, the current income, well, that's the other piece of it. You get to see it live. You're getting current income out of it, and advisors love that. Clients love that. Unlike private equity or venture, where you
Mhm.
got to kind of wait it out a little bit. And so, the combination of the interest rate market, the fact that it's a new return stream that clients didn't have access to, the fact that it continues to work really well, is just fueling that continued growth and interest. Private equity is a little bit behind that, but there's still, and private equity is so vast. I mean, it's really just like it's the U.S. economy, it's the world economy. That's the public stock market, but on the private side. And so the numbers you quoted are accurate, but again, the penetration, if you peel that back a little bit, the penetration's not anywhere. It's still first inning penetration.
Totally. Now, one question I had about those asset classes: does private equity, like in the iCapital classification system, does that include venture capital, or is
Yeah,
venture?
it definitely does. Private equity, there's different categories of it. There's buyout, there's growth equity, there's venture equity, and we participate in all three. I mean, more of our activity is in growth and in buyout, and venture. I mean, venture is the ultimate class today where there's been an economic reset. I mean, the valuation reset in venture capital is astonishing right now. Well, it was also astonishing how high it got, but it's materially reset. So again, probably one of those great vintage years. We're working with a couple of vintage venture managers right now that we'll be introducing in the first part of next year. But again, it's an uphill battle there in some ways because valuations have come down. People see headlines. People understandably get anxious about it, and so you gotta really try harder to introduce early stage growth venture to financial advisors and their clients today.
Now, is venture, I mean, in my mind at least, it's something I associate more with like endowments and institutional investors. Has that been something that has been a little bit later to grow on the iCapital platform that you're seeing, offered to retail high net worth investors versus, let's say, institutionals or family offices?
Well, yes and no. We were introducing venture funds to our client base many years ago. I mean, we're a 10-year-old company, so I'd probably say 7 or 8 years ago. But having said that, if you looked at all the offerings that we've had over that period, venture is a very small portion of it.
Mhm.
And so, the ones that we did introduce were exceptional returns, but the amount of money we raised was not what it was versus private equity buyout funds or private equity growth funds. And again, I think it's just the risk profile, despite the fact that those returns have been really great. It's a riskier asset class, and people are going to position that accordingly. So we haven't had as much traction, but it's slowly growing. It'll never be as big as those other categories within private equity, but it's definitely it's a regular part of our repertoire here, but just on a smaller portion in terms of the number of funds that we introduce and the amount of volumes of assets that we see going into them.
But it's still great that it's represented on your platform, and that it's an asset class that advisors now have access to, whether it's on your platform or others. And thank you, by the way. I think you've settled an argument that I've had with my business partner, Jimmy, where he questioned if venture capital was technically part of private equity. I assured him it was. So I think you've settled that bet for us. The only other kind of footnote is sometimes he uses the phrase private equity real estate. And I'm like, well, Jimmy, that phrase just confuses everybody. Private equity real estate, right?
Well, yeah, I mean, look, there's equity and debt in real estate. So, he's probably right in that description.
Yeah, we need like a periodic table of alternative investments or just some sort of official classification system. But again, back to the survey, why I'm referring to your all survey so much. I feel like maybe if there is an objective and authoritative reference point, it might be you guys. Okay, so kudos to iCapital.
Thank you.
And I want to move on to the benefits. You already alluded to this, Steve, already in the conversation. What is perceived as the primary benefit or the most popular benefits of investing in alternatives, right? Because ultimately, that justifies why the space even exists, right? If there's not a reason to put alternative investments or private investments in a portfolio, probably the growth disappears. So in terms of the survey, a majority, 60% of advisors expect private markets to outperform public markets over the next 12 months. When surveyed on the top benefits of alternatives, 8 out of 10 advisors cited diversification, differentiation, and access to sophisticated products came in at number 2 and number 3. So the top benefit, that portfolio diversification that I mentioned, IPA is always touting. Number 2 and 3 kind of sound a little bit like sales and marketing to me. Like these are sexy. And by the way, that's okay. It's okay that investing can be a little bit fun and a little bit exclusive, right?
Yeah. Yeah, I think that one of the things you mentioned earlier was this feedback that we got that actually surprised me a little bit, where majority advisors were indicating that private markets would outperform public markets. And the reason that surprised me is because how poorly public markets did last year, which tends to mean that they outperform in the following year, which is exactly what's happening this year, right?
But and Steve, sorry to interrupt, but I'm even thinking of public REITs versus private REITs, and I'm thinking, well, public REITs, the market kind of writes them down immediately in real time and almost over exaggerates the write down, right? So that is counterintuitive.
Yeah, I think, but then when you think about why people are using private assets, the number one point there was diversification. And if you think about it, the financial advisor community has moved more and more and more to a fee-based asset allocation, financial planning model. And in doing that, one of the key tenets of that construction is to dampen volatility. And by introducing private markets into a public market asset allocation, you're absolutely getting closer to achieving that goal, because the streams of income and returns that you'll see in private equity and private real estate and private credit are much more stable. And the NAV of the products aren't at the whim of the markets. As we saw last year with public market mutual funds and SMAs and the like, you get redemptions and things get marked down. To your point about REITs, for instance, public REITs. So the benefits of adding private assets into a public market portfolio absolutely immediately deliver on diversification and dampening of volatility, and that's why That was not a surprise to us.
Yeah, and I go back to, it's interesting. Again, we're at episode 160 some odd of this show. And when we launched it, I talked about the three benefits of alts that most people mention. That first one, the portfolio diversification. Second, the potential for alpha, not necessarily that you get alpha, but that you can, historically with endowments and, institutional investors, you think of how they generated alpha. And then the third big benefit, the tax benefits, because so many of these different wrappers or asset classes come with tax benefits. But increasingly, I'm realizing it really is that diversification is by far that primary benefit. And then if I'm going to rank a second benefit, I'm actually going to go with tax benefits as a private investor.
Yeah, I think that's probably right. I mean, although I don't want to dismiss the alpha piece, because it's just so apparent with private equity, especially. And if you are able to focus on or have access to top tier private equity managers, every data point that you look at evidences the outperformance versus public market comparisons. It takes longer to achieve. You need to be a patient investor. It is illiquid, and therefore you have to size it appropriately in your portfolio. But that is a huge, huge benefit, in addition to diversification and in addition to tax benefits that you'll get out of some, not all, but some of the strategies. And
Steve, do you think that I'm sorry, do you think that alpha though, is it distributed, to the alternative investment space as a whole? If we kind of average all alternative investors into a group and take the mean, do you think there's alpha versus public markets there, or is it only, for those who are accessing kind of that top quartile of the best managers?
Well, it's an interesting question. If you combine private equity and private real estate and private credit and infra together, I'd have to think about that. With private equity, it absolutely is the case. And if you have access to top quartile managers, you're going to do exceptionally well. I mean, it's just, I don't have the data at my fingertips here, but I mean, just everything that we look at and have looked at for many, many years, it evidences that really, really clearly. And so having the right fund selection, the right research partnership, and identifying and getting access to those managers, it really, really pays for itself. The interesting thing, though, when you think about alpha, when I think about like private credit and I think about alpha, I almost don't think about it that way. I think about it as having access to a new asset class. Again, private credit was never really made available to private clients, to individual investors. And so, is there alpha in private lending versus public markets? I think the answer is yes, but it's this whole new category that private clients, retail investors, and the like just never had access to. You could never put it into a portfolio.
Yeah, and maybe we could say it offers enhanced returns relative to its risk profile.
Yes.
But my point is, because I don't have that data at my fingertips. I don't even know if it exists. Maybe it does. By the way, if this data exists, I would love for someone to send it to me. If you kind of blended all these asset classes together, took the mean return or the median return, how does that compare to a 60-40 over time? I think that would be an interesting question. But my point was actually that I don't even know that it matters if it performed identically to that traditional portfolio, but added portfolio diversification and came with tax benefits. Which really then net you out to better returns over time, right?
I can say this confidently. The returns, if you scrapped your 60-40 and went, 60-40 in private markets, 60% in private equity and 40% in private debt and real estate, you will absolutely have outperformed the public market comparison. You will also absolutely be very illiquid. And so when we look at and some of the things that we're doing right now, and just on the cusp of offering, are multi-manager private asset portfolios where we combine private equity funds with private credit funds with private real estate funds. And just by adding that piece to a public 60-40 portfolio, we can evidence very clearly higher returns and lower volatility, like immediate impact. But you just have to come back to sizing it right,
Yeah.
because people can't live off an illiquid portfolio. And, if you're in the harvest mode, or if you need the income and so forth, or the liquidity, for lifestyle purposes, you have to be very careful how you size it.
It's a really interesting product idea. I could see where it would create a lot of value, because I'm thinking if I'm Yale or Harvard endowment, I can take my alt allocation and then slice and dice it accordingly, and buy huge institutional assets and still be very diversified. It's a lot harder. Like, unless you're a family office with 100 million or
Yeah.
more in assets, it is hard to diversify into things like venture, where the minimum investment might be, forget about 100,000, it might be
Yeah.
a million or higher.
That's right. And that's in many ways where we and some of our competitors, come in, because, one of the things that we offer are feeder funds. They feed into these larger, private asset funds, where somebody can then invest at $100,000, per slug, so to speak, versus what are the stated minimums from the underlying private asset managers. But I think when we talk to financial advisors, a lot of them, they understand the need to start diversifying into private markets, number one. Number two, they'll look at our menu of choices, and they'll be intrigued by the different things. But many times they'll turn to us and say, which ones do I buy? Just, can you make it easy for me?
Yeah.
And part of it is, well, here's an asset allocated portfolio that we've designed, and here's how it will impact your 60/40 stock and bond portfolio. And with this click, you can get access to those managers, right? Rather than having to think, oh, maybe I'll buy this real estate fund and this private equity fund and this venture fund. It might be an easier way, especially for kind of the middle tier of clients, to just get that access kind of with one click.
Yeah, that doesn't surprise me, that feedback that you might get from advisors or investors, like, this is all fine. And I mean, I even get this, like, Andy, let's hear the spiel. Tell me about alts, yada, yada, yada. This is all cool. It's exclusive. But okay, at the end of the day, what do I do? And by
Yeah.
the way, you need to be able to explain it in 20 seconds or less, because
Yes.
and that brings me, I wanted to talk about the knowledge gap, and, some of this, what we're talking about with advisors. I was thinking about the knowledge gap, and I think I have the solution. We just need to give every advisor like 36 hours in a day
You're
instead of
right.
24 hours, and they'll have the time to become an expert in all of these asset classes, and this will be easy, right? I mean,
Yeah.
it's hard. Being an advisor, it's hard because there's only so many hours in a day.
Yeah. And then you have to think about, so I think the top, or one of the top needs or acknowledgments around education and so forth from financial advisors was around portfolio construction. Like, where does this fit? A lot of it's product specific. Okay, how does this fund work? How do they make money and things like that? But what we're seeing more and more from like an education and research perspective is like, where does this fit? How do I use it? And that's coming from how financial advisors run their books. They live in the world of model portfolios.
Mm-hmm.
And if you can't show where private assets, alternative investments fit into that model portfolio, you're kind of banging your head against the wall. And you end up just like selling a fund. And, they're like, okay, interesting story, but, where does it fit? And, how does it fit within, my existing portfolio? And so that feedback, we've been hearing that for years. It's very clear that it came through in the advisor survey, but it's also kind of given us the fuel to create more of these asset allocation and model portfolio tools. We are actually just about to launch, and I'd love to come back and talk to you at some point about this, a new tool at iCapital called iCapital Architect. And it is, as far as we can see, really the first portfolio allocation tool that financial advisors can use that will allow them to incorporate private assets into public market portfolios. And you can actually download specific funds and upload a client's portfolio, include that, and it gives all kinds of interesting metrics and illustrations on why you'd want to include private assets into a portfolio, how you should size them, what the benefits of that are ultimately. And we think that that's really the future, because that's how financial advisors interact with their clients. They're not really selling products anymore. They're not coming with stock ideas and,
Right.
like this fund's going to outperform that one. They're talking about asset allocation. And so that's the world that we are excited to kind of live and participate in.
Yes. Solve big problems, think holistically. And yeah, I mean, I'm looking at my outline of, what I wanted to talk about, and I have in my notes the knowledge gap, because according to the survey, just 1/4 of advisors feel, quote, very knowledgeable when it comes to alternative investments as a category. And I kind of made I was joking around. We just need 36 hours a day and this will all be fine. But maybe it's tools like the one that you mentioned that are the solution, because maybe we're never going to live in a world where every advisor is quite knowledgeable about private credit, or are we?
Yeah. I don't think so. I mean, not in the next several years. I mean, look, we have lots of research here that we produce around the different types of private credit. And I think it's having an impact. I think it's very user friendly. But again, a lot of those advisors just say, tell me what to buy. you know, and like I get it, but I don't have the time to go deep. I don't have 36 hours, Andy, as you said. So they're looking for the easy button. And, the private asset community can take a page from the public asset world, where model portfolios and SMAs, this is really what started to like drive activity away from the single fund sale, away from the single stock sale. And the private asset community, ourselves and all the folks that we work with, are learning from that, need to learn from that. And you need to find the way to, construct things to make the consumption and the inclusion in a portfolio easier. This tool, I think is going to be, I already know we're in like beta phase with about 300 different advisors right now. And the feedback has been tremendous because the output from it is tremendous. I mean, they can get it in front of clients, they can show the impact, and they're not slinging a fund,
Yeah, totally. Yeah. And I think, I'm not an advisor, but it's like I don't need more homework. Can you please give me something that
Yeah,
makes my life easier?
yeah,
Not a homework assignment.
yeah,
We're almost out of time, but one other thing I wanted to bring up that was in the survey: challenges. These are obviously, there's challenges in alternative investments. We have huge growth, but the challenges, you run into these every day, various areas. The top two that were cited by the advisors in the survey were lack of liquidity and long lockup periods. That one's boring. I don't really want to talk about that. That one kind of bores me. I've covered it a lot. I even view it as a feature sometimes rather than a bug. But the other
yeah.
one,
Thank you. It's right.
the other one was high fees. I'm happy to talk about high fees. I'm happy to beat up our space a little bit. I mean, I will say that active management, managing these assets, takes good people. Good people cost money because you have to pay them, what they deserve, what they
Yeah,
earn. So I think active management, which I think is required in a lot of these asset classes like venture or private credit. So I think that, it kind of comes with the territory. At the same time, God bless Vanguard, just in our financial space in general, where they've put this kind of pressure on cost. I think really it kind of secretly affects everyone. Like in the back of my mind, I compare everyone to Vanguard, and it's not fair,
yeah.
but I think a lot of consumers kind of think like that. So I think there's more just overall pressure on fees. Do you think that fees are coming down in the alt space over time?
Yeah, they are already. And there's some very specific material areas, like especially in non-traded REITs. The old version of non-traded REITs was frankly offensive in the fee paradigm. The new breed of non-traded REITs, it's very reasonable. The thing we have to remember with private markets is there's no benchmarking, there's no hugging. And so you're really paying for investors to find opportunities. And the fees, as I mentioned earlier, if you just compare a private asset allocated portfolio versus a public market portfolio, the private asset portfolio would have done handsomely better, even net of fees.
Mm-hmm.
But the good thing, to your point, though, is within that, the fees are coming down. And there's a lot of new breeds of products that I think are also contributing to that. There's this whole new breed of registered private equity funds. These are funds that you can buy on they're like open-ended funds. You can subscribe to them every single month. They're fully funded. There's no drawdown, and they provide really great access to some of the top managers in the world. This is something that will really be, in our view, exploding a lot. This is something we can be talking about over the next several years. And the fees within those are very reasonable. Again, they are still participating in private markets. There is no benchmarking there. They are finding unique opportunities. They need to be paid for that. And you want those managers, in fact, to be paid. We've seen in certain circumstances, if you're not remunerating the top portfolio managers, they leave. And a lot of the institutional investors, they ask those questions very specifically. Tell me about the compensation for your managers, because we want them to stay. Otherwise you end up getting a diluted return, and there's no one at the helm, so to speak. So the trend is in the right direction, but I wouldn't be so pushy around fees in private markets right now. That's an index game, and thank goodness for Vanguard, because they've done an exceptional job for investors around the world.
Yeah, well, and I don't think I'm unique. The open-ended private equity funds that you were just referring to, I think that was the same vehicle that I read about in a recent issue of Barron's. They did like a feature article on, increased retail access to alternatives, and talking about, private equity finally going mainstream. I feel like I hear that once a year, every year.
Yeah.
Probably always will. But again, the Barron's author was, certainly I would think, kind of a friendly to the industry, but maybe not, because he kept talking about fees. And I'm thinking, this guy's just like me. He's comparing everybody to Vanguard, but
yeah. Look, it's natural to compare to Vanguard. I mean, that's the benchmark. You're getting something virtually free, but you're getting an index, that usually a market cap weighted index, thing in your portfolio. And there's just a lot of other things that you can introduce into your portfolio that provide bona fide alpha versus certainly anything that's benchmarked in the public markets, but you have to pay for it.
Absolutely. Well, Steve, we're almost out of time. Are there any other trends, big picture trends that you're seeing right now that you think advisors, investors, industry professionals should be keeping an eye on?
Keeping an eye on, I think this registered private equity space is really gonna take hold, and I think any usage of these portfolio allocation tools is something that we should keep an eye on, because I really think that's going to be the breakthrough to getting more financial advisors and private clients comfortable with getting in that private asset swim lane. And so that's really, it's part of this whole education initiative that the industry and we at iCapital have, but that's what probably excites us the most right now.
Absolutely. Well, on that note, Steve, where can our audience of advisors and investors go to learn more about iCapital and all of your tools and resources?
Yeah, iCapital.com is the place to come. And, we have sales representatives all over the country, or for that matter, all over the world. And I think if you go there, it's a great destination to start, and you can actually begin to log in and register, and then we can, interact with the community directly. We are B2B business, so we don't really have a big footprint with individual investors, more so financial advisors. And so if you're an individual investor and you're hearing this, ask your financial advisor. We work with the largest financial advisors across the country. It's not just the big wires, it's the regional broker dealers, and certainly the independent financial advisors, and start to ask them about how to incorporate alternative investment streams more into your portfolio. And we'd love to help in that process.
Awesome. And I also want to note that you all publish great research, a lot of which we've talked about today, but some of that, I'm assuming not all of it, but some of it is publicly available.
Absolutely. Yeah. And we have the largest library of private asset research out there across the categories that I just said. And, it's topical. Sometimes it's fund specific related. A lot of times it's industry related or asset class related. It's debunking this vernacular that we talked about to make it a little bit easier. We produce a lot of materials around asset allocation. Those get a lot of take up. So there's a wealth of information there, and not all of it, but most of it is publicly available.
Absolutely. And I'll be sure to link to, obviously, the iCapital website. I'm going to link to the prior episode that Steve and I recorded together, episode 54, in our show notes. And I'm also going to track down some of the links to some of this recent research, because I think it's really good. All of that will be in our show notes, which are always available on wealthchannel.com. Steve, thanks again for joining the show today.
We love your show, Andy. Thanks for including me today.